everyone. Hope you are enjoying your Monday evening and you guys are rested from your Thanksgiving holidays and back to work. So I wanted to come live tonight to go over a few tax tips for year-end tax planning for self-employed individuals. I went over this a little while, a couple of weeks ago, but I wanted to actually touch base with you guys again, go over a few of these, and I broke it down to my top 5 tonight. So if you are watching me live, if you will please say hello in the comments. And if you have any questions throughout this, don't hesitate to reach out. And if you're catching this as a replay, please don't forget to do hashtag replay. Sorry, guys. So if you're new to our channel, my name is Stephanie Manley, and I am with Calculated Profits. I am a virtual CFO and business strategist. I'm here to help you with your tax, finance, and accounting questions and needs. All right, so let's get started. First of all, there is only 31 days until the end of 2020. Some of you are very excited about that because 2020 has been a very chaotic year. But some of us may be really nervous because that means we only have 31 days to make any changes before tax time. All right, so diving straight in today. And also, before I get started, I have a really big announcement that I'm going to announce at the end of my live tonight. So stay tuned all the way to the end so you can find out what's coming up. It's really exciting. All right, so number 1 tax tip is time your income and your expenses. So what does that mean? This is probably the easiest tax saving strategy that there is, okay? What that means is if you guys have invoices that you normally send out at the end of December, wait and save those until January of 2021. Because if you're in a cash basis accounting system, you pay income tax on income that you received that year. So not billed out, but received. So any money that you put into your bank account before December 31st, 2020, you will pay income tax on for 2020. Okay, so that is your defer income part of that. The second part of this is to accelerate your expenses. Well, what does that mean? That means go ahead and pay all your bills before December 31st. So if those bills come in, or maybe they haven't come in, go ahead and reach out to those service providers and ask them, hey, send me my bill so I can get you paid. Remember, cash basis, you deduct all expenses that have been paid in the tax year. Okay, so we're going to defer income by not collecting on some of that income until January, and then you're going to accelerate expenses, which means that you're going to go ahead and pay some of those expenses in 2020. Okay, so that is time your income and your expenses. All right, we're going to move on to number 2, and that is to make the most of depreciation. Well, what the heck is depreciation? All right, well, let me explain. So when you go and buy large items, maybe it's a computer, maybe it's a vehicle for your business, a large piece of equipment, those types of items are not just write-offs like your utilities would be or your rent would be, okay? Those are assets to your company, and those have to be depreciated. Well, thankful for a tax code that allows us to write off up to 100% of most of the assets that you guys are purchasing in the year that they are purchased. Okay, so that does not mean you have to have paid for the entire item. So maybe you bought a $100,000 piece of equipment that typically you would write off over 7 years, okay? And you set up payments on this piece of equipment. So you don't write off the payment, you write off the $100,000 for that piece of equipment that you wrote off. And as you pay the payments on that equipment, you're going to write off the interest. So that is it's a one-time write-off, okay? So make the most of that. If you are in need of an item, go ahead and purchase that before the end of the year. Go ahead and pay for it. Now, I am not a fan of just going out and buying things because you show a profit on your profit and loss. Don't do that. Buying items are not dollar per dollar. So if you go spend $100,000, it doesn't mean you're going to save $100,000. Okay. So just make sure that you're making wise, calculated business decisions. Okay. All right. So we're moving on. We make sure we don't have any questions on this. Hey guys. Hey Bridget. Hey Patsy. I see another Facebook user. You guys, you have to allow StreamYard to let me know who you are. So if you haven't already done that, just select that you allow StreamYard for me to see who you are. So thank you guys for joining. All right, I'm going to go back here. There we go. All right, so number 1 was time your income and expenses. Number 2 is make the most of depreciation. All right, so number 3 is one that gets missed a lot. Okay, not a lot of people talk about this because it's not directly related to tax. And that is fund those retirement accounts. You guys, being self-employed, you're not working for a company who is matching your contributions. Okay, it's real easy when you're an employee that you just say, yeah, take 3% off the top, and your company matches the 3%. And by the time you retire, you've got a nest egg sitting there. Well, being self-employed is much more difficult than that. You have to make an effort to put up money for retirement. Okay, I started really, really late on this bandwagon. So I'm preaching to the choir when I tell you guys this, but learn from my mistakes and start early. Okay, start early. Just put it away. You're not going to miss it. So fund those retirement accounts. So I'm going to look at a little cheat sheet here. I've got a couple things to talk to you about. So the first one, when you're self-employed, is you have a SEP IRA. That's SEP IRA. And in those, you can actually contribute up to 20% of your net earnings from self-employment. Okay, so that's option 1 for you guys. Option 2, if you have payroll in your company. So if you are an S corporation, C corporation, S corporation, not C, you can do 401ks. So that is an option as well. And then you have the regular just IRA accounts, okay? And those are broken into 2 different categories. Both of those have a max limit of $6,000 a year or $7,000 if you're over the age of 50. And there are also some other income limits and exclusions that apply with that as well. But the 2 types of IRAs are your traditional, which most people think that's the one that I want because I'm going to save taxes right now. If I contribute $6,000, that's $6,000 of income that I don't have to pay tax on right now. And then I'm good to go. Okay. Not necessarily the best option, I will tell you that. The second option for an IRA is a Roth IRA. So a Roth IRA is not going to give you the tax savings now because you're paying taxes on that money, but you're going to save later. So when you draw the money out of the Roth when you become of age, or actually you can draw it out, there's some caveats to that, a little early, but you're going to save taxes on that money later. Okay, now I know this sounds silly, but I'm going to tell you personally, I think the Roths are best. I'm not a financial advisor and I'm not giving you advice for yourself. But I would say talk with a financial advisor on this because Roth IRAs are going to be, in my opinion, your best route. Okay. So you have SEP IRAs, self-employed 401ks, and then you have traditional and you have Roth IRAs as well. Okay. So see a financial advisor on these if this is something that you want to do, but I highly recommend if you are self-employed, don't wait another year. Go ahead and start putting up for retirement. Okay. You can't live off of Social Security, guys, and who knows if it's even going to be there by the time we retire. All right. So number 4 is make payroll changes. All right. And I have 2 different things on this one. So payroll changes. 1, a lot of companies who have employees on payroll love to give out year-end bonuses, or they love to give a Christmas bonus. And now is the time to start thinking of those. You've got 25 days until Christmas from today. I know, shock. and you have 31 days until the end of the year. This payroll has to be done before the end of the year. You have to write those payroll checks before 2020 comes to an end. Okay. So look at that. Maybe look at some of your employees. Maybe they are in need of a raise. Maybe it's time for a bonus for them. Those are some things that you can do to make those changes. Now, if you have children that are of working age, and I do not mean that 16 or 18 to be a working age, okay? I have a 10-year-old who helps in my business. Yes. Okay. What can a 10-year-old do? Well, he can take out the trash. He can shred. He can stuff envelopes for me. Those types of things are legit jobs that my 10-year-old can do. Okay. I also have an 18-year-old. Okay. She helps me with marketing. She helps me with emails. She helps me with a lot of things. Okay. So they're still my dependents. I'm still claiming them on my tax return, but I'm also paying them out of my business because they legitimately help me in my company. Okay. With that being said, that's a write-off to my business, number one. And number two, my children who are working, I could keep saying that, but it's very important. You can't just pay your children, okay? They have to work in your business. They can make up to $12,400 in 2020 and not pay a dime of federal income tax. Okay? So I have two children. Say they both made that much money. My 10-year-old didn't, of course. But let's just say that's close to $25,000 right there in payroll that they're not paying any income tax on. And guess what? Neither am I, because it's a write-off to me. Okay. So these are things. And if you did not catch my video from a couple of weeks ago about tax planning, these are the things that I'm talking about, guys. So tax planning is very, very important. These are the steps that you need to start taking in January. Don't wait until there's only 31 days left to start implementing some of these tax codes that help your business and save you. So that would be number 4, make some tax changes. So maybe you have some employees that need bonuses, or maybe your kids need to be put on the payroll. Okay, so they got 31 days. They better start working and making some money. Okay, any questions so far? I'm going to go check. Nope. All right. I'm going to keep going then. All right. So number 5 this year is going to be 2020 is not the year for DIY. Okay. And why do I say that? I say that for several reasons. Number 1, tax codes are changing. It's election year. Number 1, we have no clue what's about to happen, guys. And then, there's things out there like the Paycheck Protection Program. This was money that you guys got as a loan that you're hoping to have. What is the word I'm looking for? Oh my goodness, it just completely left me. Anyway, you're hoping that they will actually clear out that loan for you, so you don't have to pay the loan back. Well, here's the trick, guys. Whatever you spent that loan on, whether it be payroll, rent, utilities, and that loan is forgiven, there's the word, and that loan is forgiven, you cannot write off those expenses. So you can't have it both ways. You can't have the loan forgiven and write off what you spent the money for. So those things have got to be taken into account when you file your tax return. Okay. The second thing is many of you got the economic injury disaster loans. Well, that again is important. That plays into your tax return again this year. So it's not the year to DIY. DIY your marketing if you want, DIY other things, but your taxes are not something that I want you guys to DIY. So find a tax preparer, accountant, a virtual CFO that you trust, that you click with, and that you guys can work together to get your taxes prepared accurately. The last thing you want is to prepare a tax return that is inaccurate and you have to start dealing with Uncle Sam. Okay, so just do it right from the beginning. All right, so any questions on any of my top 5 tips? Nope, nothing yet. All right, cool. So quick run through one more time. Time, income, and expenses. Make the most of your depreciation. Fund retirement accounts. make payroll changes. And lastly, 2020 is not the year for DIY. Okay. And I told you guys that I have a little announcement at the end. So I'm about to tell you that. But before I give you my big announcement, I need some feedback from you guys. Is 8 o'clock a good time, or is another time better? Some of you may just be watching this as a replay every time, and that's fine too. But I'd like it to be where you guys can jump on live with me. So if you have any questions as we go through this, I can answer those for you live if possible. So, shoot me a comment on this and tell me, yeah, 8 o'clock is great, or no, I need it earlier in the day or later at night, whatever it may be. I am here to make things easier for you. That's the only reason that I do these lives, guys. I want you to understand your numbers so that you can be successful in your business. Okay. So, my announcement today is, I can't, none of you see this. Can you? There we go. Can you see? Everybody knows what the check mark is, right? All right, so this is a $100 Amazon gift card that I am going to be giving away very soon. As soon as my group, the Thriving Entrepreneur Squad, hits 100 members, I'm going to be giving away this $100 gift card. Some of you may not have a clue how to get into that group, so I'm going to show you really fast. I'm going to click over to, here we go. All right, I'm going to share my screen. Awesome. Yay. Okay, trying to figure out this technology, guys. It's a different world that we're living in now. But I am very glad that you joined me tonight. Again, if you are live, if you'll just say hello so I know you're on live. And if you're catching me as a replay, if you will hashtag replay, I'd greatly appreciate it. All right, guys, have an awesome week. And if you need me, don't hesitate to send me a message. Have a good one. See you later.